Okay, I think we can get cracking. Share the screen. So we've been talking collective investments, looked at some of the finer points, and been talking about class of shares, taxation, the fees in particular, which can have a bearing. And today we move on with unit trusts. Soon as I can get my device going. Just 2 seconds here, guys. Right, let's kick off with the remainder of collective investments then. Set this up real quick. Coffee. Right, we then move on to unit trusts as per our discussions. Fairly familiar ground when it comes to unit trusts. I know that there are quite a few retail investors to whom unit trusts are also attractive, right? It's an investment fund that is established as a trust in which the trustee is the legal owner of the underlying assets and the unit holders are the beneficial owners. Now, if you remember some of the discussions that we've already had in relation to collective investments is the funds are pooled together, creates a bigger fund, and then it is invested in different mechanisms. As a result of this process, the pooling of funds gives us the benefit of a larger quantum, which allows us to diversify better, which gives us access to different investment strategies, and on top of which we have access to professional investment management, right? Unit trust, you're going to see the same structures in place, and now we are learning the nitty-gritties of it, right? Some of the key points across over here, which I'm sure some of you are most likely familiar with, but nevertheless, let's touch base on. It is importantly established as a trust, where the trustee is the legal owner of the underlying assets. The unit holders, which is you and me or the retail investors who will invest the asset, are the beneficial holders, right? We'll see what these finer points are about as we go along. The unit trust structure, more often than not, will give us a open-ended fund structure. Again, if you remember, open-ended meaning new shares can be issued and redeemed, and as a result, if the fund manager wants to grow the portfolio, grow the unit trust, he can easily do so by issuing new shares. Investors deal with the fund directly. If you want to buy units of the fund, you want to get exposure to this unit trust. It could be a equity market strategy. It could be a fixed income strategy. It could be a GSE, government securities unit trust, right? Which the fund is investing in. Any of these you can get access to. If you want exposure to these, how do you go about it? You need to approach the fund directly and purchase via the fund. Main distinctions between the unit trust and an open-ended fund, there is a distinction there, is that the parties to the trust and how it is priced. You do see this trustee coming into the picture here, dual price with a bid buy or an offer sell price in the process. Right? We'll talk about it as we go now. Number one, the parties to the unit trust. You have the unit trust managers, right, who determines which investments to be included in the trust within the constraints and regulations. Like I mentioned, for example, if we look at it on a standalone basis, we can have an equity market investment unit trust. We can have a fixed income unit trust, which is invested in, let's say, debentures, for example. Or we can have a government securities related, or we can even have a more common one, which you see across the board, a money market unit trust. Any of these we can have. Or we can even have, for example, a fixed income GSEC and money market structure, although a little not very popular, not very, I wouldn't say popular, but not very frequently found around. Right. So the unit trust manager will be involved with determining what the portfolio is going to look like. Very importantly, within the constraints and regulations put down. Because when you are initially creating the unit trust, you will have certain ideas, structures that you will market across. So Gal, that's just terminology. We are talking about the same aspect, but it's just terminology. No major differences across over there. It's purely terminology based, right? Um, where were we? Yeah, within the structure and regulation. For example, there might be certain regulations at a point of time, or even now with regard to certain investment strategies, that through the government, they will tell you, for instance, only high net worth individuals can make this investment. Right? Then you need to make sure that KYC will filter the respective type of investor. Or based on the structure, you can only invest in government securities. And you need to follow the respective regulation or constraints within the respective mandate. Uh, these two can be maybe included in the mandate, which obviously needs to be. Sorry, guys, just lost you there for a bit. I have no idea how, but this lecture in particular, the internet gives trouble. I have no clue how that happens. It's like the algorithm, there's like an algorithm picking and choosing and giving me trouble. Just this. The connections have been pretty decent over the last couple of, I think, since the rains have settled, it's a lot better. Anyhow, um, so as we were talking about, there are instances which, particularly in the Sri Lankan context, which we can apply where you see the investment management and the unit trust overlap. Same entity. But you might have in more developed markets where you have the ability to raise the funds and you don't necessarily have the investment management expertise. In that context, for example, you can see the investment management being outsourced. Um, yes. I did do the repeat, Prakash. Hope that was okay. And there was a hand raised. Question, guys. Feel free to ask away.
I, I I raised an area again, asked to ask for repeat only. Okay, sir.
Done, right? Okay, we are good. Excellent.
Good.
Um, Next point. Provides a market for investors willing to buy and sell. So you're approaching the fund to buy and sell, which will create that liquidity position as well, and carries out pricing based on net asset value. That buy sell values will be based on the net asset value of the fund. Because when it comes to valuing other assets, for instance, right? Some of you in the industry or related industries will know valuation, present value of future cash flows, relative valuations, multiples-based valuations, which is the same thing, earnings-based valuations. There are so many different methodologies that we can go to in order to value the asset. But here, we base it on purely net asset value, right? It being a monetary element, it makes sense, right? But valuation is not a, we don't dive into detail here. The trustee plays an important role. Why? I mean, just as the name suggests, guys, right? This trustee comes into place to protect the unit holders, right? Organizations that the unit holders can trust with their assets, because there could be hundreds or thousands of unit holders. All of them can't get involved in, I mean, doesn't make rational. There is no rationale behind all of them getting involved in the management or how to protect or how do I manage. That doesn't work. So how does the structure work? The unit holders will invest through the fund, but the funds, the assets are held with the trustee and will be managed by the investment manager. Normally, I'm pretty sure you guys are familiar with the trustee services. Normally, large banks or institutions, insurance companies, etc., can act as the trustees. Very important academic point as well as otherwise as well, operational element. The trustee is the legal owner of the trust. Right? This could be a popular question. Who is the legal owner of the trust? The trustee. Who holds the asset for the benefit of the underlying unit holders, which is why we say the unit holders have beneficial interest. Right? Monitors the actions of the unit trust manager on behalf of the investors to make sure that their investment is secure. Is he going outside the mandate? Is he taking unnecessary risk? Is the liquidity going to be an issue? These elements, the trustee will monitor on behalf of the unit holders, which is a key service which is being provided to the unit holder. Which then brings us to OEICs, open-ended investment companies. We touched based on this a little bit earlier as well. It's a form of investment fund visible in Europe, right? Pretty much open-ended element. Investment company with a variable capital. Now, that itself should give you an indication what we are talking about, right? I'll come back to that. As a company with the investors holding shares, and investors deal directly with the fund when they wish to buy and sell. Now, we spoke about two types of funds. One fund is, there is no change in the size, locked in. The other fund, what happens is, the size can change. If the fund manager wants, he can issue new shares. This is what we recognize as the open-ended fund. This is what we recognize as the closed-ended. If you wanted to exposure to the closed-ended fund through an exchange, for example, you will enter. If you want exposure to the open-ended fund, at any given point, you can use the fund manager and get the exposure. So you can appreciate, right? Is investment company with a variable capital. This one doesn't have the variable capital. This one, on the other hand, does have the variable capital, which is how, in an European context, it is recognized. Okay. Parties to an open-ended investment company. When setting up the fund, it is required to appoint an authorized corporate director and a depository. Now, these are also academic points. I mean, yeah, operational as well. But from an academic perspective, it's going to play an important role in the exam because they can ask you these questions from an European context or from an open-ended investment company context. Where do you see an authorized corporate director or where do you see a depository? Where do you see the trustee? Trustee comes with the unit trust. Depository comes with the OEIC. Authorized corporate director comes with the OEIC. Considering the structure of the exam, these are elements that we need to be familiar with. What's the role of the authorized corporate director? Is responsible for the management of the fund. With the unit trust, we said investment manager, which is the jargon that we in a local context also mostly use. Investment, valuing, pricing, dealing with investors, maintaining a register of shareholders or unit holders, for example, all these will fall under the authorized corporate director. The investments held by the independent depository, which is similar to a trust. We are playing with language, right? Very simple. Looks after the investments, oversees the activities of the authorized corporate director on behalf of the shareholder. These distinctions in terms of lingo, we need to be familiar with from an exam perspective, guys, right? Because it's popular areas which you can see coming across. Pricing. You have an option in a new open-ended investment company context. You have the pricing to be single or dual. Single meaning you only have one price to enter into, or otherwise dual meaning you have a buy or sell. Quick question, in open-ended fund, unit price should be more stable in comparison to the closed-ended one. That would again depend on demand and supply, right? And how the fund is performing, right? Because if the net asset value changes, your price is going to change, right? So the main factors will be demand and supply for the units versus the performance of the fund. Because if your fund is doing better and better and better, let's say hypothetically you're talking about a trading fund where there is constant trading, and if you're getting your strategies right, your net asset value is going to increase in the fund. Then the prices will go up. Then the demand will come. Then the prices will go up further, right? Makes sense? I think that was Malik. Yeah. I hope that made sense, Malik. Yeah.
Yes.
Single pricing refers to the use of a mid-market price by us divided by 2 essentially of the underlying assets to produce a single price at which investors can buy and sell. Commissions, charges, etc. As we've seen, there's quite a few as it applies to the funds are identified separately. Open and closed call we spoke about in our last session, where closed-ended funds, there are no new shares that will be issued. There is only, let's say we issue 100,000 shares, there's only going to be 100,000. If an investor wants to access this fund, they will have to buy out of the 100,000 shares from another investor, for example. With an open-ended fund, for example, if I am the investor and I want to buy and I want exposure to this fund, I will approach the fund manager. We don't have to take the existing share. Fund manager will issue new shares for us. Open-ended versus a closed-ended fund. That in a nutshell is what open and close was talking about. You do find certain funds, I believe, closed-ended as well, which you can access through the market. But I don't know how the liquidity works there. Yeah. I think from a commercial perspective also, that over there, I mean, it's good to get more investors on board, grow the fund, because in terms of AUMs, assets under management, is the biggest criteria that will drive the fund. And as a result, I think the open-ended one will tend to be more attractive in that context as well. Unless you have like a bigger quantum super investment management and a great strategy to grow the fund purely on net assets. Okay. I'm just thinking out loud here. Excellent. Good questions, guys. Um, Other fund structures. Now, these are also interesting, right? Fund of funds. What happens here then? A fund of funds utilizes one overall fund manager, but they invest in a portfolio of other existing investment funds. So you have the investors who are investing in my fund, for example, and this fund, instead of their own investment strategy, are basically piggybacking on the investment strategies of other funds, which is obviously why it is called a fund of funds. This one can, for example, be an equity fund. This one might be a fixed income fund. This one might be a money market fund, etc. I ignore that point. Most fund of fund schemes are managed on an unfettered basis. What does this mean? Where the component funds are run by a number of managers external to the fund management group marketing the fund of funds. This sounds complicated, but through this structure, you're going to see the visibility of it. The component funds, these are the component funds. The component funds are managed by external fund managers. You can see that here, right? So you'll have a fund manager here, we will have a fund manager here, and you'll have a fund manager here. And all of these are separate entities, maybe. All of these are separate entities, A, B, and C, which is external to the group marketing the fund. Who is marketing the funds? This, at this level, is where the marketing of the fund is taking place with the investors. So you can see how the main fund, investors, these are the guys marketing the investors to invest in the fund. We have access to other funds and managers who are external to the fund marketing the fund. Fettered products are obliged to invest solely in funds run by the same management group as the fund. On the unfettered basis is where you will see the fund of funds coming. When we use these fettered products, for instance, there you have an obligation to invest in the funds run by the same management group. There, the entire umbrella which we were speaking about has to come under the same fund management group. So the investment managers, the fund managers will be internal to the company. You can have multi-manager funds. Right? Here, the fund arrangers segregated mandates and appoint fund managers who they believe are the best in their sector to manage each area. So still within the company, multi-manager funds. The initial investment conventionally is very high compared to other types of funds. These are the characteristics which it is classified by. It also takes time, excuse me, it also takes time to change from an underperforming manager as opposed to a fund of fund approach. Why is that? Fund of funds, let's say this is our fund. Then we have the external funds. We'll call it Fund A, Fund B, and Fund C. Right? This is us, and these are the external funds. right? What we are saying is, in a multi-manager context, right? We have fund one, we have fund two, three, and four. Here, all are internal. These are all internal. But this last statement is saying is, it's easier to change this structure than it is to change this structure. Does that make sense, guys? See, if we are not happy with the external fund manager, I pull my funds out, I find an alternative and I invest. If I have a problem with one of my funds internal, now how I'm going to reconstitute, how I'm going to change my investment strategy, that is going to involve a fair bit of work. That process can be time consuming and sometimes extremely so even. And there have been funds even in a local context, although I won't mention names, which have had these issues. Whether it's a fund manager, whether it's the investment strategy, or whether it's a key client moving out even, they've had to change over the entire process. And when clients lose confidence in you, they'll pull all the money out. You have a bad rep in the market, and then rebuilding the position is going to be fairly challenging, right? Although the companies have done that. Closed-ended investment companies, right? So again, we touched based on these previously as well. Set number of shares issued and listed in the exchange. Investors who want to purchase, this time around, they are not coming to the fund. They are going to go to the stock exchange and buy the listed shares. Capital is fixed. It doesn't grow and does not expand or contract like an open-ended fund. In the open-ended fund, the fund manager can expand or he can contract the funds the way he sees fit. US closed-ended funds. A variety of funds can increase to include different investment objectives. No problems with that. There are a number of funds which are attracting investors for any number of different investment strategies. Growth, value, growth at any cost, distressed investment, equity neutral strategies, merger acquisition strategies, event driven strategies, all which we will see in a bit. There can be any number of investment strategies, right? Different investment objectives, portfolios, which will be subject to different risk. You choosing to invest your pool of funds in an equity strategy versus you choosing to invest your funds in the money market has completely different risk return profiles. We've already seen that. Higher the risk, higher the return. Equities, risk is high, potential return is also high. Money market strategy, risk is extremely at the lower end, so is the return. Allowed to invest in a greater number of illiquid securities in the US context, right? Now, what happens when we bring these illiquid securities into the equation, guys? Essentially, the risk is going to increase. This is where previously in the US in particular, even now, certain investment strategies will come with conditions, regulatory conditions, that it is only applicable, it is only suitable to a certain type of investors. For example, high net worth investors. Let's say my hedge fund or mutual fund strategy is one where I use an extremely high amount of leverage in order to magnify the return. Now, this risk profile will not be suitable for every type of investor, particularly not the retail guys, given the risk profile. Then regulatory wise, they will come in and lock in that condition. It is because you don't, they are for it's being prudent. You don't want the retailers to come in a big way, looking at that return. But if the markets do turn, which is possible, and the fund tanks, the retailers can't stomach it. And there will be a huge loss of confidence and social cost. To avoid those issues, the regulator obviously steps in. Unit investment trust, we spoke about these, similar to a closed-ended fund, makes an IPO offering. Sponsors of the fund will maintain a secondary market for the purpose of liquidity. In the event an investor wants to buy or sell, enter into or exit his position, that is possible. Does not actively trade its investment portfolio. So you're looking not at a trading, but an investment for portfolio. Buys relatively fixed portfolio of securities, example, 10 or 20 specific stocks or bonds, and hold them with little or no change over the life of the fund. Now, when we are recommending this, why do we want to understand these type of funds? When we are recommending it to our clients, when we are including it in our portfolios, it needs to be suitable. Meaning what? The liquidity profile here is very clearly long term. If that is not suitable, you putting your monies in there or recommending your clients to invest their monies in there is not appropriate. When we go into the next chapter, fiduciary responsibilities, suitability is something we'll keep harping on about. In Europe, closed-end funds are usually known as investment trusts or more recently investment companies. Again, the jargon which we need to be familiar with, right? Interestingly, this is not a trust. In fact, it is a company, which changes the game a bit. Similar to that of a company, you have a board of directors, you have shareholders, etc. Not the trustee structure, right? Similar to a unit trust, will invest in a diversified portfolio, allowing the shareholders to reduce their risk. So I will invest in the company, I am a shareholder, and through the fund, I will have exposure to a diversified portfolio. You have something called a split capital investment trust, where the investment trust has also issued preference shares as well as ordinary shares. Right? It is in one way, if you look at it, because preference shares will usually carry preference dividends. That is a known number. It is like, and of course, preference shares more often than not are redeemable. It's like using margin. I take the funds, I use it to generate a return, I grow my portfolio, settle the preference guys at the redemption date, and they are out. I use the money, grew my portfolio. Thank you very much. See you later. In contrast with open-ended investment companies and unit trusts, investment trust companies are allowed to borrow money on a long-term basis by taking out bank loans or issuing bonds and other distinguishing characteristics. These we need to be familiar. And of course, as a result of introducing debt, which has a fixed charge capital and it has a known tenor, we can use that to grow our funds through the return and pay the debt down eventually, and we would have grown our portfolio. Right? Similarly, what we will do with margin trading, right? Some investment trusts have finite dates for winding up. So they are not, in operation for the foreseeable future. They have finite periods which they will be in operation for. The share price of a closed-end investment company, in contrast to open-ended ones, will not necessarily be the same value of the underlying investments. These are listed instruments, right? The company will value the fund daily and provide details to the exchange. Subsequent prices will be decided by demand and supply in the market, just like any other security in the exchange. Which also means sometimes you might be making losses, but purely because there is demand, rational or not, you may see a positive price movement. I was looking at something today, that's why it came to my mind. An investment trust is listed on a stock exchange where secondary trading takes place. Anything closed-ended, that characteristic we will see being carried forward. ETFs, exchange traded funds, right? We are after looking at understanding the basics of an ETF. A type of open-ended investment fund which is listed and traded on an exchange. We were initially told open-ended investment companies, if you want to invest in them, not through the exchange, but you will go through fund, the fund manager. Now with exchange traded funds, the ETF, we are saying it is an open-ended fund, but it is traded in an exchange. The investment companies and liquidity will be provided by the market. Obviously, price discovery is there. If you want to buy or sell, you will have the price which you can do so at. Typically, ETFs track the performance of an index and trade close to their net asset value. When we say typically tracks the performance of an index, guys, we've had these discussions previously, just checking whether they are still fresh within the mind. What sort of profile is there here, guys? What sort of risk profile is there here, guys? When we say it is tracking an index. Thoughts? What sort of a risk profile is there? See, we are not doing, this is what we call a passive investment, right? Meaning, we are going to replicate an index and forget about it. Well, not forget about it. We'll talk more about the tracking in a bit. We are basically tracking an index. I am not thinking, is it a value low price now, sell high later, growth option is there, growth at any cost, growth at a good price. I'm not thinking any of that. All I'm doing is the S&P SL20, I'm going to replicate my portfolio in that exact percentages. Very simple, nothing else complicated. Very passive approach. You'll only trade, we'll fine tune these discussions as we go on. You'll only see movement in the portfolio fund to rebalance to, because when the prices change, obviously the weighting in the index will change. To match that, you will have some buying and selling. That's it. No buy low, sell high, value, growth, la di da, nada. Right. Depending on the index being tracked, the liquidity can vary. If you talk about a large cap index, for example, liquidity may not be as available. Or on the other hand, you replicate, let's say, penny stock index, in a Sri Lankan context, if you look at it cents, 50 cents, 25 cents, whatever. If we replicate that sort of an index, the liquidity, of course, will be relatively much higher. What are the different features, therefore? Tracks the performance. You can track the performance of any index, right? Be it equity, debt. You want to track the index of a particular sector. You want to track the index of a particular theme, all which we will talk about as we go along. All this is possible, right? Details of the fund are transparent and therefore net asset value is readily calculatable. Where it is being invested, it is easily visible for you to see. Continuous real-time pricing and therefore readily tradable. Listed in an exchange, pricing is available. You want to buy or sell at any given time, that possibility exists. Because of its liquidity, the bit of a spreads, the difference between the buying and selling price is low. Relatively low expense ratio. There is no initial or exit charges, only the commission from trading. You want to buy or sell, you go to the exchange and you buy or sell. If you go through the fund manager, sometimes remember the front end fees, the back end fees, the management fee, la di da, the whole gamut of it might be applicable. For a fund, of course, the management fee is anyway applicable, which will typically be deducted from the fund, usually 0.5% or 50 basis points or less. With these exchange traded funds, since this indexing is a factor in there, we distinguish between the different types of indexing that we can follow. Obviously, the first and most easy one is full replication, right? Well, most easy in one context at least. The index is exactly mirrored in terms of what the fund is exactly mirrored in terms of what the index looks like. The S&P, let's look at a hypothetical situation. Let's say we have an S&P SL5 for ease, right? I have the weighting in on each stock at 20%. That is how the portfolio, that is how the index has been created. Let's say the five stocks are JK, Commercial Bank, Dialog, hypothetically Expo, which is moving out, and let's say Tokyo, whatever. This is the S&P SL5. Each one, how is the index created? 20%. I have $100 million portfolio. Full replication is what? I will replicate this in its entirety. 20 million to JKH, Combank, Dial, Expo, and Tokyo. Very simple. When the prices change and the weightings change, now when the price change, let's say JKH price goes up, obviously its weighting is going to go up. Let's say this moves up to 25%, this is at 21%, and vice versa, right? I'll have to rebalance my portfolio to meet this record. Right? Those are some of the issues with the replication method, which we don't dive into the detail, at least in your content. Then come now, would you say this is an efficient method of indexing, guys? Let's see what your thoughts are. Would you say this is efficient?
Is it it's depend on the investor's risk appetite?
No, the indexing, guys, not the fund. I'm saying this indexing approach. This indexing approach, would we say, is it efficient? Right. Now see, that's why in my illustration, I took S&P SL5, a hypothetical index, right? Let's take it to the existing one even. This is also doable. S&P SL20. Now there are 20 stocks there, which the price movements can happen daily, which can also be material. And then I have to rebalance 20 stocks in my portfolio, meaning buying and selling, to match these 20 stocks in the index. Now imagine it this way. The index I am replicating is the FTSE 100. 100 stocks. That is what I'm trying to replicate. And when the price movements happen and the ratings change, with full replications trying to mirror this, will be nightmare and chaos trying to replicate this, isn't it, guys? Not exactly the most efficient way to go about it, right? You can see the number of stocks will have a direct implication to the complexity, which brings us to the options, right? We go to the next level, stratified sampling. Choosing investments that are representative of the index. The overall tracking error, this is very important, we'll talk about this, or departure from the index will be relatively low. So what do? I have the S&P SL20. Or alternatively, if we go a little crazy, the FTSE 100. I'm not going to do a full replication out of this, which, for example, will explain about 90 to 95% of the movement, and I'm going to use this in my pool of funds as the replication, not 20. I'm only going to use 8. Stratified sample. To a great extent, it will replicate the movement in the index, but there is going to be a 5 to 10% error, meaning it won't match. If the index moved up by 100 basis points, I only moved up by hypothetically 80 basis points. There will be a mismatch. Why is that mismatch coming? Because I'm not doing full replication. If I was doing full replication, the tracking error is relatively, it's potentially very, very low. In fact, near zero. But when I do stratified sampling, I'm only selecting a few of the counters to replicate the performance of the index. But because of the tracking error where we don't match it in its entirety, there will be a small deviation, which is this what we call the tracking error. The more efficient the stratified sampling is, the lower the tracking error. If you go with some random process of selecting the stocks, obviously your tracking error is going to be much higher. Right? Now, even in this, if you say FTSE 100 and you're trying to select a few stocks which replicates it, you might be thinking of about 30 to 40 stocks. That's still quite a few stocks, right? To rebalance, reconstitute, etc. Which brings us to our next model, optimization. Don't forget, we are still under ETFs, computer-based modeling technique. It aims to approximate the index through a complex statistical analysis based on past performance. For example, I will run a regression analysis. Right? What is the regression analysis going to tell me? Of the variables in the index, meaning the counters, which ones have the greatest explanatory power over its movement? Let's say hypothetically in our S&P SL20, our regression equation told us 4 counters have the explanatory power of about 80 to 85%. I'm being hypothetical here, right? 4 counters. Now the optimized sampling approach is going to be a lot more efficient. It is driven based on data and numbers. This approach is more common for indices with a large number of components, FTSE 500, FTSE 100, etc. The provider, meaning the fund, will only buy a basket of the selected components reflecting the same risk return characteristics, right? Now, because of this regression analysis, let's say now data analysis is quite significant, right? Now we are not looking 3, 5, 7 years. We might be looking 20 to 30 years. And what is the regression? Explanatory power, which will tell us where we want to put our monies. Again, not directly part of the curriculum, but what do you think is a weakness over here, guys? I'm just asking you, this is part of that improving the thinking. What do you think is a potential, not weakness, but a concern, something that we need to focus on? Any thoughts?
Since it's a computer-based modeling technique, there is a probability of having correct and
Probability of having
correct
a correct.
implications.
Usually the computer-based models are pretty good. I am saying, is there any fundamental element that we need to be concerned about? Look carefully there. The answer is there. Thoughts? I'll come to it. The factor is this complex analysis is based on past performance. We are assuming that these relationships, integrations, interactions, etc. of our optimized computer model is going to continue to the future. Is going to continue in the future, which may or may not be accurate. Make sense? Right? These are elements. That is where machine learning comes into the picture. Machine learning will learn the trends and adapt the algorithms to it. And the new ones are based on past performance, but it is adapted to the newer environment. And that is what the machine learning is, what is eventually taken into artificial intelligence as well. That's the sequence, right? Data analysis, big data, machine learning, artificial intelligence. Today, you can't suddenly go to artificial intelligence because you need significant information. You look at the last 100 years of stock exchange movement, that's big data, which will be analyzed, the data analytics, which will be used for the algorithm to learn on its own and eventually make decisions on its own. That's the artificial intelligence we will go with, right? Just something to think about.
So
Although
effectively, this will not take into account the future performance of that particular stocks. That is, maybe the market might change, the macro factors might change, all those.
the relationships can change, right?
Yeah, everything. Yeah.
Exactly. Exactly what I was talking about. Exactly. And finally, we come to synthetic replication. This involves the ETF provider entering into a swap agreement with a single or multiple counterparties. I'll explain what happens with a swap is, guys. Some space. The provider agrees to pay the return of a predefined basket of security to the swap provider in exchange for the return. Now, this is the most important statement here, right? Let's say, for example, this is the fund. The fund is invested in a particular basket of stocks. Right? But what is the fund promising? Not the return on the basket of stocks. The fund is promising its investors. The fund is promising the investors the return on an index, not the return on a basket of stocks, right? Bear in mind. Therefore, what does the fund do? This is the importance. I told you structures and derivatives. Remember, I would have mentioned this. Therefore, what does the fund do? They enter into a swap arrangement with a swap counterpart. What is the arrangement? The swap counterparty pays the excuse me, guys. What is the arrangement? The swap counterparty pays the fund the return on the respective index, and I will pay the swap counterparty the return on the basket of stocks. Return on the basket of stocks. Now what is happening? Despite me having a separate basket of stocks, right? I am paying the return on this to the swap counterparty. What is the swap counterparty paying me? He is paying me the return on the index. What do I have to pay the investors? The return on the index. Right? And think of it this way. Let's say the basket of stocks perform negatively. It's that negative return which is applicable, meaning I will get the return on the basket of stocks also because it's negative. In addition to assuming the index perform positive, right? Swap arrangements. You might ask, how does this work? Without going into the detail, which can be technical, in developed markets, because of the breadth and depth of the markets, you will have parties willing to trade in most structures. And as a result, in most situations, you will have reciprocal transactions for so many different funds. because you have the speculators, you have the hedgers, you have the arbitrageurs, and you have so many different investment strategies, expectations, and investment objectives. I mean, the scope is so huge. So more often than not, you can structure something somewhere where you can pull out of somewhere, the swap counterparty will have the requirement for the respective exposure to the respective basket of stocks.
So this is probably the high risk investors comes into play in the swap
Why would
area,
you say that? Why would you say that?
private
Good,
equity.
good point. Good point. Why would you say that?
Because it is high risk. So not all the investors willing to put the money in that.
Not necessarily. Now, I will tell you again, not part of the curriculum, but since it was brought up, I will tell you something, right? What do you think is going to happen to the tracking error here, guys? What do you think is going to be the tracking error here? Or the tracking risk? Is the tracking error high or low? The tracking error is low. Why? I am getting the performance of the index from the sub counterparty, which I can use to pay my investors. Tracking error is actually low. So technically the risk is low, right? But there is a risk. The risk comes from the derivative. The risk comes from the derivative, the swap.
Yeah.
Again, outside the syllabus, but I'm telling you it's not something difficult to figure out. When it comes to swap, guys, now it's not an exchange traded option, right? You find some counterparty somewhere. You're in Europe, the swap counterparty might be in Asia. You're in Sri Lanka, the swap counterparty might be in China. You're in America, the swap counterparty might be in Russia. What's the issue? There is always a major, with swaps, there is a major third party credit risk. Third party credit risk. Ah, great. I have a swap counterparty. Fine. I found a guy in Russia who is willing to enter into a swap arrangement with me. Right? Now, let's say hypothetically, the basket of goods perform negatively. The index perform positively. So I need to get the index return. Plus, this guy needs to compensate me negatively, right? If it is positive, it will go to him. Negative, it has to come to me. What is the easiest thing for the swap counterparty to do? Disappear. I won't have my hedging or return or arbitrage or speculation. Nothing in the book. That is where the risk lies, right? Although not part of the syllabus again, for knowledge purposes, I thought I'll introduce you to it. All right. Okay, let's not overcomplicate things, but I hope you get the idea. That's why, I mean, with derivatives, the structures, even I have limited knowledge there, to be honest, but the structures are quite amazing what you can do. Because so many structures, so many different periods, swaps can go up to 30 years. None of the other derivative instruments go that far. You can find swaps which go up to 30 years across the investment horizon, which is massive, right? And with swaps, I think I took this very same example with you guys previously as well. I have invested in fixed income, right? An easier swap understanding. I have invested, my portfolio of funds is in fixed income. But my research tells me most likely in the future, the term structure of interest rates is going to go down. Equities are going to perform, right? Now I'm thinking, how do I manage to capitalize on that opportunity? What do I have to do if I go operationally? If I go, I have to liquidate my entire exposure in the fixed income market, which will involve a cost, which will involve an administration and all those burdens. And then I'll have to rebalance it or reconstitute it across into equities. I'll have to select the securities. I'll have to make the investments. There is a trading cost. And eventually, when the term structure reverts back to its normal structure, liquidate the equity portfolios, which will involve administrative and trading costs, and then come back into the fixed income market, utter chaos, right? Now, in a Sri Lankan context, that's what you'll have to do, no option, right? But in developed markets where the derivatives are available, what do? You enter into a 1-year swap. Because I am assuming, okay, for 1 year, I have issues with the term structure. That is my expectation. Post 1 year, I want to have exposure back into fixed income. During that 1 year only, I want to have equity exposure. What happens? I enter into a 1 year swap. During that 1 year, I tell the swap counterparty, you pay me the equity return, I'll pay you the fixed income return. So for 1 year, I will enjoy that benefit. Assuming my expectations come good, I will enjoy the equity returns. And I won't have the exposure to fixed income. At the end of 1 year, swap is concluded. My exposure is back to my original one. But did I have to liquidate my fixed income position, take a position in equities, liquidate the equities, come back into fixed income? Nothing of the sort. My exposures remain the same. But on paper, we exchange the stream of income flows, fixed income to equity. At the end of 1 year, we reverted back to original exposure. No problem at all. Which is brilliant, right? Which is brilliant. So many options, therefore, exist. Okay, let's not spend too much time there. I mean, it's exciting to talk about these things, all awesome structures in place. So ETFs, as we already know, generate, track an index, but latest models follow a smart beta approach. Instead of purely tracking an index, now we are slowly moving from passive to a little more active oriented investment strategy. Instead of purely tracking an index, they will also take into account factors such as value, growth, etc. Now we are moving into the realm of active investment management. I'm not only replicating the index with no other investment strategy in place, only a pure passive play. I'm also looking at, are there undervalued stocks? Are there stocks which have a growth option? Can I buy into them at a good price? Now I'm starting to think active investment management. It can possess, therefore, the characteristics of both active and passive investments due to considering these alternative factors. Conclusion. Main advantage of physical full replication obviously is the simplicity, but it comes with a massive cost, trying to keep the tracking error at a, reasonable level. The main advantage of synthetic replication is lower tracking error, not zero, lower cost, because you're talking only about a few sample of counters which replicates the performance of the index. But of course, there can be certain tracking errors. As you can appreciate, this tracking error, that's why I highlighted it. The tracking error is a major consideration as it applies to ETF investing, because there is a balance. To reduce the tracking error drastically, the level of replication has to increase quite some. The moment the level of replication increases, when you try to balance it all, you'll have to be buying and selling to match the percentages. Tracking error is low, cost is high. When you go to something like stratified sampling, tracking error is not, we don't exactly replicate the index. We replicate it to a great extent. Cost is low, but the tracking error increases. High tracking error, basically what we are trying to describe across here is there is larger deviation from the index. It is not necessarily a downside. It's not a downside. It's definitely not a downside. Why? If we are talking tracking error, we are saying how much are we equal to or not equal to the respective index. If the tracking error is lower, we are talking about full replication. If the tracking error is higher, for example, we might be talking, let's say, synthetic sampling. Sorry, not synthetic. We are talking about stratified sample. There is a certain return component that will come here. Because the costs are high, the return is low. But the tracking error is also low. Lower the risk, lower the return. When you move to the other end of the spectrum, your tracking error is lower. So, sorry, your tracking error is higher, but your costs are lower. higher return will come at a higher risk. How will the higher return also come? You will balance it in such a way that you might have more exposure to positive performing counters in the index. Again, not part of the syllabus, so let's not dive into that. Right? So as long as obviously the return compensate, we are going to be pretty happy about it. Right? Which brings us to commodity funds, small area. Right? So we are basically looking at the application of commodity funds. Popular investment in the portfolio of private clients. What do you think, guys? Why is that? Why do you think this is possible?
Because of the risk that it is, because the commodity is moves ups and downs, very fast. So
Close. We've spoken about this, guys. We've spoken about this. You can relate to something. We've spoken about this. Commodities. Why do you think they might be popular in general? In general, leave the private clients aside. See, where do most of the conventional funds go? Conventionally, when an investor is looking to park his money, think in Sri Lankan context. Conventionally, where does it go? Fixed income and equities.
equity.
Now is the why would we want to introduce commodities? Because we spoke about the correlations. Correlation between commodities and conventional investment instruments is a little low. By us introducing commodities, we have better diversification benefits. Which is why we'd like to introduce it into our portfolio. Great, right? Usually, exposure is gained by investing in companies in the respective industry. This is a form of, obviously, direct investing. This can carry a risk as the dual exposure that the company and the company exposes the investment manager. Now, when we have the investment manager who decides to make an investment in a commodity company. Let's say this is listed. Obviously, the value of which is derived from the respective commodity market prices. The issue for us is what? If I went, let's say I was using a derivative instrument to get access to commodity futures, for example, then I will only be exposed to fluctuating commodity prices. But here, not only will I be exposed to the commodity prices, but there can be demand and supply, which could, for the respective companies' shares, there can be fluctuations in the market conditions, which will affect the price of the company as well. So it's a double-edged sword. I'm getting hit on both ends, right? But does it mean that you won't invest in it? Futures and options are alternative means of gaining exposures, but generally not for retail clients because the quantum, understanding the market, understanding the derivative markets, those expertise can be issues. But like I told you, this dotted line, for example, I can gain exposure to commodities through futures or options market. Now, this is an important point. An alternative is to invest in an exchange traded commodity fund. This is an investment vehicle which tracks the performance of an underlying commodity. Now you have that same fund structure. You have the retailers or the retail investors investing in the fund. Now the fund is big. Now the quantum is there. Now the professional investment management is there. These guys will, through the exchange traded commodity fund, will invest in the respective commodity. Right? For the usual benefits, obviously the retail investors will stand to benefit. You will get the exposure and you will get the respective diversification. You will get the respective professional investment management. ETCs are open to all types of investors because the risk can be diversified because the quantum is there. Rather than you going and investing by yourself in an exposure to commodities. Open-ended collective investment vehicles and are dealt on a stock exchange. Right, what we'll do is structured products, a little technical, not rocket science. What we'll do is we'll jump into a break. We've spoken a few technicalities on structures as well. Let's take a break, and when we come back, we'll dive into the structured products. Right, as usual, any questions, feel free to put it up. We'll respond to when we get back. Okay, we continue on with structured products. These are essentially packaged products, right? We'll see why we are going to go with these packaged products. Packaged products based on derivatives, which are created to meet the specific needs of more often than not high net worth individuals and general retail investors that cannot be met by financial instruments that are available in the market. Right? You might want a situation where you want the downside to be hedged, but you want unlimited upside potential. I mean, you're going and putting money in equities, you're going and putting money in fixed income, you're going and putting money in money markets. They don't entirely give you this structure, right? But when we combine instruments together, there is the potential to give us that requirement, right? We're seeing more, that's why it's called structured products. We're looking at more, bringing in those structures to meet our objective base. These are available in a variety of structures aimed at mass retail investors. Sorry guys, just lost power here. Let me work with whatever I have. I'll keep the video off to save some bandwidth. Right. Where were we? Available on a variety of structures aimed at mass retail high net worth, ultra wealthy investors, etc. Right? The structures can work for either of them. Obviously, the risk profile will change depending on how you're going to structure it. We've got an illustration. Let's see how by combining underlying assets with derivatives, underlying assets meaning the likes of shares, bonds, indices, currencies, commodities, how when we bring these together and combine it with derivatives, how can we create these structures, right? This is what we're after. So an investor has $1,000 to invest. There are two underlying investments in the project. One is the zero coupon bond, which is essentially the underlying, and the other is a call option, which is essentially the derivative. Right? Zero coupon bond, we know what the structure is like. You don't have any intermediary coupons coming to you. At the end of the tenor, you will receive the return. How? Because it is issued at a discount, in fact, at a deep discount. And when it is redeemed, the face value will be given to you. And obviously the deep discount is going to be your return. What do we mean by a call option? Gives the option holder the right to buy the underlying at the respective strike price. Right? So zero coupon bond does not pay any coupons. And as we defined, there is an $800 investment. At the maturity, you will have the face value coming to you. And of course, the return to you is going to be that $200. Therefore, now this is the important point. Therefore, capital preservation is guaranteed. How is that? Regardless of the direction in the market, interest rate, coupons, blah, 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 fair values, at the end of the day, you are going to have $1,000 in your hand. Why? At time zero, on the zero coupon bond, you put down $800. At time N, when the bond matures, you're getting $1,000. Come whatever, assuming there is no credit event, of course. That's a qualitative criteria. At the maturity of this structure, $1,000 is a given to you. So what have we done? Essentially, in my structure, I have hedged my downside risk to $1,000. No matter what, I'm going to have $1,000 in my hand. Right? And out of this $1,000 I had to invest, I've only put down 800. But as a result of the zero coupon one, regardless, I'm going to get $1,000. So 1,000 what I had to start off with, and regardless of what happens, 1,000 is going to be in my hand at the end of the structure. Capital preservation is guaranteed. What do we now? 800 has gone into the zero coupon bond, which means I have another $200 to play around with in order to get some upside out of this transaction. The remaining 200 is invested in a call option on an equity index, which means it gives me the right to buy or call or receive the return on the equity index. The return on the equity index. So base case scenario, $1,000 zero coupon component is certain to be received. That is how I have ensured my downside risk is covered as well as my capital preservation is guaranteed. Scenario 1. The equity index return is positive, meaning index value at time N or time 2 is greater than the index value at time 0. Therefore, what am I going to do? I'm going to exercise the option. When I exercise the option, what is going to happen? I am going to have the $1,000 which is coming to me from the zero coupon fund plus the equity return, because I have the right to call the equity return, which means I am going to have $1,000 plus the equity return. Now what has happened? The upside potential is coming to me. And regardless of the structure, as long as whatever the rate the equity market goes up to, I will obviously call it and make a return on it. So here I'm having upside, I'll have $1,000 plus, right? Unlimited upside potential. If the market goes crazy and, has a major bull run, you're going to reap the rewards on the $200, $1,000 base case plus the positive return in the market. Scenario 2, the equity index return is negative, meaning time 2 or time n value is less than the time 0 value. Now, are you going to call the option? If you exercise the option now, you will get a negative value. Obviously, you're not going to call the option, you're going to let the option lapse. When you let the option lapse, you are not going to have an equity return. You will only have the 0 coupon bond face value coming to you. So, regardless of the structure going down, this is not applicable to you because I have hedged my downside. Minimum, I'll have $1,000 and maximum upside potential is technically unlimited. See, I have preserved my capital while still having an upside potential. In fact, an unlimited upside potential.
So there should be a premium for the
benefits.
production, right?
Yes. Very good point to note there. This will obviously be reduced by the option premium. And of course, it's going to be like, let's say, $60 or 100, not can't be $100, $80, something like that, right? It will be reduced by the option premium. Correct, you are right. Good observation. Benefits of structured products. You saw how the capital protection was maintained. It is tax efficient if you're talking about investing in access to taxable investments. Enhanced return because we are opening ourselves from the $200 to the potential upside. We have the opportunity to capitalize on that potential upside. Reduced risk because we are talking about a 0 coupon bond, which is close to risk-free, not risk-free, not completely risk-free, or let's say low risk, and the derivative instrument. We are combining two different asset classes, a low risk one, derivative, of course, if the call option is out of the money, the risk is high, but we are combining 80% in a low risk asset, 20% in a derivative to manage the risk appetite that we may have. Which brings us to the types of structured products. Now you saw the basic structure, a very layman structure, to be honest. This could be played around with in order to achieve certain structures, right? Let's see what they looked at. Structured deposits. Excuse me. We can have a fixed term, 3 to 6 year, for example, deposit account, earning a fixed return, fixed income. The performance depends on an underlying asset, example, S&P 500, right? Let's see an illustration. If the product offers a return of 15%, if the index is at or above a set level, if the index at the end of the tenor is at or above, the investor will receive capital plus 15% of the index. If it is below, he will only receive the capital. So here, investor will also benefit from potential deposit protection schemes because they have invested in a fixed income return. Again, we are preserving capital with the potential to return above the index. Plus, we have that additional benefit of the deposit protection scheme from the country, provided that is applicable, that will of course help to reduce the risks, right? So return profile is similar to what we saw in our illustration, capital protection plus upside, but with the additional benefit of deposit protection scheme. So that was structured deposits, right? Where we had the fixed term plus. Then we have the structured capital protected products designed to return capital at minimum, which is similar to the structured deposit we saw earlier. Typically contains features beyond structured deposits to offer a high return. Meaning, instead of investing in an index, which we have discussed previously in the day to be more passive, we will invest, for example, in equity. This one is relatively more high risk. This one is relatively more low risk. Same structure, only element is that the derivative instrument in particular is going to be directed to a different asset class with a higher risk return profile. Now you're seeing as we move from structured deposits to structured capital protected products, the risk profile has increased slightly. Then comes the structured capital at risk products. Offers the highest return. Why is that? Hypothetically, out of that $1,000 to invest, previously I only invested 200 in a risky asset. And at the same time, I had my capital protected. No matter what, capital protected. But now what am I going to do? Let's say hypothetically, I am going to go $750 into the risky asset class. Hypothetically, only 250 going into the low or no risk asset. Now, this is not going to be adequate to protect my capital, which means I am putting quite a bit of stock in this risky asset. If this goes upward, if the market performs, I will have a major upside potential because a significant portion is invested there. Likewise, the same reciprocal pattern will be applicable. If this goes the other way, I'll have a major loss. Higher the risk, higher the return. And the loss will offset the capital even. Offers the highest return as all or some of the capital can be at risk. That is this one over here. May have partial capital protection. There can be, we can increase the magnitude of risk we are taking through, for example, margin trading, going into risky asset classes such as distressed companies. It depends on what you want to achieve. Higher the return, can you pursue? Yes. Do you want to take even more risk? You can do that with asset classes or the type of investment that you want to make. So you already spoke about considerations for investing in structured products. You have to have the ability to hold the investment to maturity. Now we were saying time 0 to time n. At time n is when you receive the face value of the 0 coupon bond. It is a time end when you are hoping for that call option to be in the money. If you decide to execute over here, you're going to have a problem. Risk of not recovering the capital. Certain structured products, as you saw, there is a situation where the product itself is risky, where your capital is at risk. And we saw with the deposit, structured deposit, there was also investor compensation as well through the country protection schemes, right? If this is not available now from a Sri Lankan context, not I think only one or two, if I'm the government institutions offer the depositor protection schemes, that too is you might get, I don't know, 40 rupees per 100 or something like that. It's not going to be complete. So there are also you stand to lose certain, but obviously relatively there is a some level of protection from the deposit protection scheme. It all characteristics which we will do well to bear in mind. Right, which brings us to hedge funds. Generally considered to be high risk. Now, hedge funds have evolved from the convention. I mean, there was a time, at any given time, when we say hedge funds, it will accompany with risk, right? That has changed. You have equity neutral strategies, you have beta neutral portfolios, you have long short positions, etc., which still have risk return profiles, which may be suited to retail investors also, right? So things have changed from what it used to be. Modern day context is that hedge fund structures are various, such as risk averse, risk taking, reduced market risk, that is that equity market neutral portfolio. Therefore, generalizing high risk, just as I mentioned, is no longer accurate. You have a variety of structures in place which will be applicable whether you are, which will be suitable whether you are a high net worth investor, ultra wealthy investor, etc. Let's say, for instance, if we are talking about a risk averse retail investor, the hedge fund strategy might be a complete fixed income strategy, no frills, or it can be a government securities portfolio. No frills, absolutely simple. And as you can see, aligning with the risk averse appetite culture, the return is also going to be relatively low. There'll be a positive return, but it's going to be relatively low. Then you are talking, let's say we are talking high net worth or ultra high net worth individuals. These guys can stomach high risk. So what do? Instead of talking about $1,000 portfolio, I am going to introduce margin, let's go crazy, at twice that portfolio. So for every dollar which is invested, there is in fact a $3 exposure. If the portfolio goes positive, the return magnitude is going to be bigger. And if the portfolio goes negative, same return situation we are going to see. This is not suitable for that retail client. It is more suitable for those who have the capacity to stomach it. Any of these structures are available from the hedge fund perspective. As you saw, right? I combine the margin trading, I can combine currencies, I can combine commodities, I can combine derivatives in order to create the structure which I want. I can take the $1,000 equity, I can take the $2,000 margin, I can take that $3,000 and go into the derivative market and increase this magnitude further. Like this. An absolute return fund. What is this trying to do? Seeks to give a positive return in all market conditions. You saw, for example, in our first illustration of the structured products, regardless of the market condition, we will have a positive return, $200 over 800 absolute minimum. If at all, I will have a, if the equity markets perform positively, I will exercise the call and I'll have an additional return coming to me. At any given context, I have a positive return. How do you achieve this? Employing a range of techniques. So you have short selling, futures, options, leverage, swaps, for example, we saw. You can go into unconventional assets such as private equity, angel investing. Any of those elements are open to us. Innovations in hedge funds. I mean, If you do some reading, if you watch a few movies, in fact, you will know that the hedge fund structures have come a long way thanks to all of these derivative instruments and structures in place. Innovations have resulted in sophisticated strategies that produce highly geared returns rather than controlling market risk, which basically exposes the investor to high risk, high return. The investment levels are generally high, therefore, it is restricted to wealthy and institutional investors. But you can access through individual basis as well, but highly restricted. Common features, structure, unauthorized. Unauthorized, therefore, unregulated collective investment scheme. If it is unauthorized, you cannot solicit the funds of the general public, which is generally the less savvy investors in the market. Because if it is regulated, there will be restrictions on the type of assets, on the investment strategy that you can use, on the level of margin debt that you can use. That is in order to protect that retail or relatively less savvy market investors. Investment entry. Minimum investment requirements can be 50,000 to, in certain cases, even £1,000,000. Flexibility. In the hedge fund space where they are unregulated, for the fund to invest in any asset class is pretty much open to them. This could be subject to certain constitutional requirements of the fund. You can take long short positions, you can go short selling, you can go margin, debt, etc. You name it, it's okay. Can borrow funds, allowed to use derivatives, which essentially enhance the returns of funds, provided your expectations of the market go in the way you are going. You enter into a short selling structure and the market, instead of going down, goes up, then you're done for. Liquidity. There is an initial lockdown period of generally between 1 to 3 months. When you put in the money after this ramping up period, they will lock it up. Because 1 month down the line, if a big investor starts taking the money out, the fund is going to suffer. And eventually, people will get scared and they'll get freaked. And if other investors also start taking the money out, the entire fund is going to collapse. So generally, there is a lock-in period. Costs. Typically have a charge for a performance-related fee. For example, 20% of net new highs. What are we saying across there? The portfolio was worth $100,000. It went to 120,000. Your new high is what? $20,000. Next, it went to $140,000. Your new high is what? $20,000, on which the management fee is 12. Which brings us to the different hedge fund strategies. Right? We touch based on some of these. Fixed income arbitrage. We don't do a deep dive into the strategies. What is this strategy about? It is aimed at exploiting inefficiencies in interest rate yield curve, corporate spreads, pricing on governments. The important point is inefficiencies in the interest rate yield curve. So essentially what is being said here is if markets are efficient, there is a certain price that the assets should trade at. When inefficiencies prevail, what you are going to see is mispricing. And due to that mispricing between that efficient market, there will be a spread on which you can take advantage of. So depending on what you're looking at, you will take a long or a short position in the market because of that inefficiency. Once the market corrects to its efficient price levels due to demand and supply in the inefficient context, then these will start bearing fruit. That is the inefficiency that we are taking advantage of. Think something simple. You're looking at a equity security dialogue. You do your calculations and recognize that the intrinsic value of the stock is 12 rupees. Currently, Dialog is trading at 9 rupees. Bingo, what do you do today? You're going to buy today. And eventually, when the price reverts to its efficient intrinsic value of 12, you will sell. You're going to make 3 rupees on the each of the shares. So obviously that's not a fixed income arbitrage strategy, but just to give you an idea about how the strategy works. We are exploiting inefficiencies. Non-directional strategies. Low volatility, low correlation during non-critical periods, strategies with traditional markets. It is not based on whether the market is going to perform positively or whether the market is going to perform negatively. It is not a critical period, because during critical periods, there can be peaks, troughs, and inefficiencies. We're talking about a normal market condition. You're looking at certain securities where based on dividend yield or capital appreciation, etc. On a basic element, you're trying to make a return. But you can understand here, because that volatility is low, is non-critical period, it is a less risky environment, the return is also going to be limited. How can I enhance my return with these non-directional strategies? You use leverage. You bring in this margin. Then what happens is you can enhance. If you are talking a 1 to 3% return as a result of introducing margin at a lower cost, you can enhance your return up to, let's say, hypothetically 5%. Then we have the market neutral, or what we call an equity arbitrage strategy. We'll combine a long and short position. So on the same security, I will have a long and short exposure, which basically means regardless of the direction in the market, my exposure to the market is zero. How do I make money on it? Stock picking. I need to pick the right stock in order to generate a return for me, maybe through the current income. Convertible arbitrage focuses on securities that have convertible features. Objective again is to profit from mispricing trends affecting influencing the price of the convertible security. Typically will involve a long position in the convertible security and a short position in the underlying stock. Without going into the technicalities, let's say I have a $100 convertible bond, which allows me to convert this into $10 shares, obviously $10 shares. In the market, the shares are trading at $14 per share. What am I going to do? Right? Basic element. I am going to exercise my conversion option. When I convert this, I will get 10 shares, each to the value of $10, which accumulates to $100. Then these shares, now I have equity shares in my hand, which in the market are worth $14 for a total value of $140. $100 convertible bond, due to the mispricing in the market, is now for me worth $140. Right? A bit of a easy explanation across over there. We can have strategic arbitrage. It's a strategy using a statistical or economic technique to provide signals for execution. You can have regression, you can have correlation, you can have variance and standard deviation, you can have interest rates, term structures, any of these technical elements in order to give you a signal whether to buy or sell, whether to remain invested or not. For example, I was swapped between the fixed income market and the equity market for a period of 1 year. Based on the notion of mean reversion, another important point. We assumed, yes, now the fixed income is going down for the next 1 year period. Therefore, I don't want the exposure, which is why during this period I swapped into an equity exposure. But my assumption is eventually mean reversion is going to come back to that usual levels. That is why in the next year, I want to get back to my fixed income exposure. This is a crucial assumption, mean reversion. Because of a large number of stocks involved, high portfolio turnover, fairly small size of the mispricing, the strategy is designed to exploit. The implementation is usually automated, and there is much attention placed on reducing trading cost. Usually, rather than don't think of the soft structure here. Let's think of an equity market, for example. This statistical strategy, we have something called, you might have even heard of it. Any thoughts, guys? Anyone heard of this? No? High
For trading.
frequency, high frequency trading, right? What happens is you will get, let's say we are talking about a $10.70 stock. My statistical tool will tell me there is a potential for it to go to $10.60, which means now my signal is to short sell in the market. But you can see how small the margin is from. Number one, I'm going to have to play with volume in order to make a decent quantum of profit. Number two is what can I do to reduce the trading cost? The more I reduce the trading costs, the higher the quantum of profit that I'm going to make. These are generally this high frequency trading. Obviously, a manual process is not entirely possible. Usually, I mean, almost entirely what you would hear is automated. And particularly now with AI, etc., the strategies are quite open in that context, right? Event driven, pretty straightforward. You can have special situations like corporate actions. If you know of a takeover, if you know of a merger, etc., based on that, let's say for example, the Sri Lankan regulators tell you that the banking sector is too saturated, or that on a standalone basis the banks can't hold its risk, and as a result they are looking at consolidation. You will do your analysis, you will find out which two banks make the most sense to merge together, and you will take the respective action. Distressed securities, an interesting area. Why would you want to invest in distressed securities? Because of their distressed nature, they will be priced at a significant discount, right? When a company is unable to meet its financial obligations, etc. But of course, you will see certain value in it where potentially turnarounds can happen, or in the short term, there can be a positive movement which you can benefit from. Merge arbitrage, similar to that event-driven stuff, similar to the special situations, to the respective approach where you will buy the target company and you will benefit from the respective strategy. Can have directional strategies purely based on what is the manager's view of the direction of a particular asset. Now you can go back to that swap structure again, the fixed income and the equity structure. Depending on the direction of the respective asset class and the markets, you will take a position. Equity hedging can be a strategy, a long and short side of the market. On the equity side, stock picking is crucial. Mispricing and market exposures, we spoke about these. Tactical trading. Global macro. The philosophy behind the global macro investing is to find large scale themes in global capital markets. For example, there are certain correlations between gold prices and developing versus developed, let's say developed versus emerging markets. What is going to happen? Bigger thing, right? Or you can also think about the dollar versus gold. You know, the moment the dollar depreciates, you see a bit of a trend towards gold. Bigger themes on the macro side of things. Systematic strategies. Mathematical models used to evaluate the markets, detect trading opportunities, generate signals and investment decisions. The statistics, which we spoke about, regression, Monte Carlo simulation, um, variance analysis and standard deviation, etc. Classified as trend following, where systems are used to ride certain trends. You might identify a particular stock. There were stocks in the Sri Lankan context as well. This is their trend. You will identify this trend. Your strategy is what is your strategy going to be? Buy low, sell high in the short term. And if you want to look at a longer term portfolio, buy low, sell high. Trend strategies. And finally, private equity. What is private equity largely classified with this from a profile? You're talking about investing in companies which are not listed. Yes. Right. But there is one fairly, it goes hand in hand with private equity always. What's that? Any thoughts? Private equity is characterized by high risk.
Risk.
Yeah, exactly. High risk. These guys, for example, will come into startups. They will come into infant companies. They will come into distressed companies. Why do they do that? Let's think about a startup. This is the life cycle. They will come in at these early stages, more often than not, right? What do they bring? They will bring funds. They will bring networks. They will bring expertise. Funds to grow, networks to grow, as well as innovate, R&D, etc. Expertise to turn around, grow, and give the impetus to the business. They will bring all of that, and since we are at infant stage, our revenues are low. Our capex is probably, requirement is high. Margins probably don't exist. Sorry, guys. Last, let's few minutes and we'll be done. Hopefully the connections you lost. Where were we? High risk. PE guys come in, for example, at the early stage. And we were saying that, revenue growth is low. Profitability non-existent. CapEx, significant requirement. Access to funds, not everybody wants to put money in there because you only have an idea, not an established business, right? So these guys will have a high bargaining power to come into the business early. And for example, they might have 30%, 50%, or whatever percentages of the business. And they are here for the medium term, not even for the long run. Generally, they are here for the medium term. We will characterize by usually 3, 5, 7, I would say maximum, which is even a stretch of 9 years. They will put all these expertise, networks, funding, etc., to bring the company to that peak. And now, what they can exit their investment, they put $1 in over here, but now when they exit, they will exit with $30 on the share. You can see again at this point of time that high risk entry position, they will expect to be compensated with a very high return. For instance, you can see the multiple on the dollar which they invested, they want 30. We are talking about a 30 times multiple, excuse me, over a 3 to 5 or 7 year period, which is huge. High the risk, high the return, right? Private equity categorization. Medium to long term, in return for equity stake in high growth companies. Venture capital, management buyouts, these are the classifications which you can see. Very low very low liquidity investment, because at this point, very difficult to exit. Even across this period of time, since we are talking about private equity, it is not listed. Maybe at this point, they might think about exiting through an IPO or otherwise, but across this period, there is no publicly available price discovery, low liquidity, high growth potential. You are seeing that across over here. Reward return is usually through how? Selling the shares back to the management, selling to another investor, could be another PE firm. They could trade, there could be an IPO. But when this comes together, this multiple which they will exit, which they will expect to exit, is going to be very significant for the risk that they took up initially. Where do the PE firms generally have access to? They will have large institutions behind them, right? It could be even IFC, for example. It could be high net worth individuals. It could be large corporations who have a private equity arm, etc. This is where the funds for the private equity firm itself comes to do the investments. It wraps up collective investments for us. Like I said, a very interesting segment which gives a fair bit of insight into some of the investment strategies as well. In our next session, or section rather, chapter, under fiduciary relationships, we will dive into more details of the investment strategies, risk cultures, etc., and talk a lot more about it. Right? Any questions, guys, before we call it a day?
Just one question on a previous slide.
Yeah.
You spoke of unauthorized funds, therefore they are unregulated.
Yes.
So in developed markets, you're allowed to invest in such.
You're allowed to do so. You're allowed to do so. Key factor there is you cannot solicit the funds of the general public. So what happens is you'll have to look at, these high net worth or institutional clients, etc., to invest. But these guys are investment savvy. So they will put pressure, they will ask the questions, and they will, structure the portfolios to meet those criteria. And they are the type of investors who have the capacity to take that level of risk. That way, all those investor confidence being lost, social cost, etc., those are not part of the equation, because you are not allowed to solicit the general public.
So then these investors also might be in high net worth individuals, is it? Or can
Yeah, it could be
funds also go and invest?
Yes, funds, high net worth individuals, institutionals, all can be part and parcel of that.
So funds will not have a sort of under their mandate any restriction saying you cannot invest in unauthorized or
That will
unregulated.
depend fund by fund.
Okay.
Because there can be funds which are like, for example, risk neutral, risk averse, and there can be funds which have the mandate to invest in high risk strategies. Then, yes, they will look at it.
Thank you.
You're welcome. Right. We shall call it a day then. I've had a long day with a lot of talking and just about to lose my voice in the process. I hope you've had an interesting session, guys. We'll join up again next week for fiduciary relationship. I can tell you is like a springboard for the investment strategies, cultures, and etc., which will bring a lot of these discussions that we've had in the previous chapters. Right. So look forward to next week. And until then, have a great week and take care, guys.
Thank you, sir.